let's take a look at an example here. We've got trade accounts payable, and trade accounts, don't get confused or anything. That's just accounts payable. Another way they could say it on the exam, totally fine. So Horatio Company buys $100,000 of inventory on terms 310 net 30 on December 15th, year one. Now, before we even read further, I want to address that, because if you're not familiar with what this means, well, that's a problem, and we should talk about that now. What that means is that Horatio buys this inventory from a company, right? $100,000 worth. What this means is that if Horatio pays the $100,000 within 10 days, Horatio will get a 3% discount on this $100,000. Now, why? Why would a company offer that to Horatio? Well, because time value money, right? You want your money now. You want it today. Money's worth more now than it is in the future. And especially if you've got multiple accounts with other companies and you're getting $100,000 from each of them, that money adds up. And that discount that you give the company might be worth it to you, right? So if they don't pay it within the 10 days, they owe the rest net 30, right? The full amount within 30 days. And they bought this inventory on December 15th, year one. Horatio uses the gross method of accounting for discounts. Lastly, Horatio pays the invoices after year end and before the discount expires. All right. Prepare the proper journal entries for when the payable is initially recorded in year one and when the account is paid in year two. Let's look at what we're going to do. Well, when the payable is initially recorded in year one, right? So this is when you make the purchase. This is when you say, hey, I want the inventory. Here's the business. Here's the invoice. Inventory purchases debited, right? So this is going to be a debit to an asset. You're increasing your asset, and credit to accounts payable. You didn't pay in cash right away, so you are going to credit your liability. You are going to credit what you owe them. The accounts payable balance would be considered current as it will be paid within 30 days. Also, it's obviously within a year. When the account is paid, Horatio would record this journal entry. Now, as the question says, it says that we get the discount before the discount expires. So we pay within 10 days. Accounts payable, you're reducing that because you have now paid off your debt to the company. You're crediting cash for only $97,000 because you did get the purchase discount, right? So 3% of $100,000 is $3,000. That's what Horatio gets. And a little note here, if Horatio were to use the perpetual system for accounting for inventory, the inventory account would be used instead. Don't worry too much about that. That is just more on the surface how it's presented. But these main journal entries, definitely important to know. Let's take another look at questions, because questions are the best way to see anything. Meriden LLC produces high quality furniture. Well, good for them. I'll be the judge of that. I need a new desk. On August 1st, it borrows $200,000 from Union Bank by signing a 12-month 8% note. So immediately I'm looking at this 12-month, that is current liability, right? And 8%, that means we are paying 8% annually on $200,000. The note stipulates that interest payments are due quarterly. So we're accruing 8% throughout the year, and we're paying it out quarterly. What would be the journal entries that Meriden should record on the issuance of the note and when interest is paid on the quarterly dates? And then lastly, at year end. So let's start out. What's the journal entry that they recorded issuance? Well, you're borrowing money. This one's pretty straightforward. You'll see the same thing with bonds if it's issued at face value. Well, you debit cash, right? Because just think, what did you get? What did you receive? Why are you doing this? Why are you doing this at all? You want cash. You need cash to fund your operations. So you debit cash for $200, credit notes payable. And at the end of the day, if you're taking the test and it's a sim, it's not going to trick you, right? It's notes payable versus accounts payable. It's a liability account. That's the main point driver, right? Is just by putting down a reasonable liability. Now, what about when we deal with our interest payments and everything else? Well, for November 1st, February 1st, May 1st, Meriden would book the following entries related to interest expense. And this is simply debit interest expense, $200,000 is the face value, times 8%, right? 8% a year, times 3 divided by 12, because it's quarterly and there are 3 months in each quarter. And that's how the calculation would work. So $4,000 of interest expense each quarter, and you're going to credit cash when you actually expend that money, right? So you are accruing the interest throughout the year and you're paying it down each quarter. Meriden needs to accrue 1 month of interest at the end of May. Since the interest expense was incurred, however, not paid out in cash yet, timing is everything, right? Because on August 1st, we are borrowing this money, right? We're borrowing this money at August 1st, and we pay out interest November, February, May, and we still have 1 month of accrual. So interest expense of $200,000 times 8% times 1 divided by 12. That gets us to interest expense of $1,333, and we haven't paid it yet. It's accrued. So it's an interest payable. It is not cash because, yes, we will pay it off in the future. I hope so, at least, right? We pay our bills. We're reliable. We just have not paid it off yet. So anything that you have not paid off yet per your payout schedule will just be an accrued, right? So this is an accrued liability, interest payable.